I'm Mary Beth Burns. I'm the president of the Wayne Economic Development Council, and we're excited to be here today. Obviously, we've assembled a great team, a talented team that's, we're so fortunate to have such talent in our own backyard. So we're excited to be here to moderate this. Anytime we have an opportunity to talk about growth and development in Wayne County, that gets us very happy and pleased and excited when we hear about new projects or things that help support growth and development in the county. So at WEDC, we're all about economic development and projects, trying to help our existing businesses grow and try and attract new businesses into Wayne County. We are the local economic development organization that works in partnership with Team NEO, who is the state's regional economic development entity, and Jobs Ohio, which is the state's economic development entity. So we're all about trying to link projects to resources that Jobs Ohio has available to help support that growth and development. In 2024, if you go to the next slide, 2024 was a great year for Wayne County. We had a lot of projects, a lot of investment in the county, which was great. We were able to attract 4 new businesses into Wayne County, which was phenomenal. And those new businesses ranged from about 10 employees to over 300. So that's a lot of new jobs. And we appreciate all of the investment in trying to help support those companies. We had about 620 plus new jobs that were created from those investments that you saw on the last slide. That was about $254 million in capital investments and about a little over 700,000 square feet of additional space that was added through those capital investments. We had 6 projects last year in Wayne County that were able to secure some Jobs Ohio dollars to support those initiatives. So that was about $1.3 million in state dollars to support those projects. And because of the projects that you saw on the last slide, Wayne County and Worcester, the Worcester Micropolitan, ranked number 3 in the state for projects last year. So that's exciting. And Wayne County and the Worcester Micropolitan have ranked consistently in the top 10 in that area. So that's great. On the next slide, one of the things that is happening this year is it's a little bit of a slowdown this year. The economic uncertainty, the fact that the ever-changing tariff landscape has businesses a little bit concerned. The RFIs, or requests for information, that come in from Jobs Ohio have slowed down a bit, and we've seen that companies are taking a little bit longer to make decisions about making capital investments. So while that's a headwind for us, we have a lot of investment that's happened so far. You can see some of the logos up there. So we're excited about what 2025 has, and we're hoping to learn a lot more today from this panel on how we can encourage and support our existing businesses. We know that 80% of our growth in Wayne County comes from existing businesses, and we're hoping that today there's a lot of helpful information that might help with some expansion and growth and development projects. So with that, I'm going to turn it over to our panel for each panelist to provide a brief introduction of yourself and the organizations that you represent today.
My name is Josh Agin. I am a senior tax manager at Ray. We have offices located all throughout the state of Ohio. I'm actually located in our Zanesville office. We do have an office here in Worcester, Ohio. I've been with the firm for 10 years, and I practice tax and have a focus in construction.
Hi, everybody. I'm Jeff Snyder. I'm the market leader for Westfield Bank here in Worcester. I'm responsible for Canton, Worcester, and Mansfield, and I live in Massillon. I've been at Westfield for about 2.5 years. We just had some news, and I'll share that because it's relevant to us, obviously. If you don't know, we were recently sold to First Financial Bank Corporation out of Cincinnati. It's about an $18.5 billion bank. Again, headquartered in Cincinnati, community-oriented. We're about $2 billion, so we're going to be about a $20 billion bank. I'm excited about it. It's going to provide us additional resource and some business offerings to help our client base. So thanks for having me today.
I'm Roger Proper. Sorry, a little loud there. I'm an attorney with the Critchfield law firm here in Worcester. I do a lot of trust and estates work, and as part of that, I represent a lot of businesses, closely held businesses, and the business owners and helping them establish, choose the type of entity that they should set up, whether it's a corporation, LLC taxed as a corporation, things along those lines, plus some transactional work with those businesses, restructuring and things along those lines. When Jeff asked me how long I've been at Critchfield, I actually had to do some math. It's been 26 and a half years now that I've been working with Critchfield, and glad to be here.
My name is Josh Long. I'm the area manager for Butler Manufacturing. We are a metal building manufacturer on new construction, re-roof, different aspects of building construction. I've been with Butler now for about 5.5 years. I have 25 years in the metal building industry, and I appreciate y'all letting me be here.
Taso Pantoulis, I'm the regional sales manager for Butler Manufacturing on the eastern United States and Canada, down to the Caribbean. So I manage a team of folks who work directly with Butler builders like Freeman to engage with corporate customers on construction projects. Pre-engineered buildings are what we're commonly known for. Pre-engineered's a little bit of a misnomer in that everything we do now is highly customized to the specific loads and codes of a project. And the process that is being enclosed. So that's why we have to work very directly with our builders to make sure that the project goes correctly.
And I'm AJ Lammers, president of Freeman Building Systems. And yeah, we're a common denominator for a lot of the panelists because when we started reaching out to people that we work closely with and have partnerships with. So just thank you to not only everyone attending, but the panelists for giving their time.
Great, thank you. So we're going to go ahead and kick off with just some predetermined questions and a little bit of a discussion on the big, beautiful bill. But we will have time for audience questions, as AJ mentioned earlier. If you're asking the question live, please wait for Jean to get with you for the microphone because this is being taped, and we want to make sure that people who are watching the broadcast afterwards have an opportunity to hear what you're saying. So with that, I'm going to turn it over first to Josh to do a little explanation. We've all heard a lot about the big, beautiful bill. Many of us have heard way too much about it, but there are so many pieces and parts to that we appreciate you giving us kind of an overview of what that means and what it might mean for Wayne County businesses.
Yeah, absolutely. So, big, beautiful bill. It was passed into law July 4th. So it's still hot off the press, and it's about a 1,000-page bill. So we're still all deciphering through it and trying to learn as we go. But you know, AJ kind of wanted me to highlight some major tax provisions as we know as of now, and how that might impact you and your business decisions and potential expansions or new construction projects that might be come to mind or it might be in your future. So obviously the big one that everybody knows, and I got my little cheat sheets here, and there is a slide deck that is in the QR code up here, and then should get a link after the event as well. So reinstatement of the 100% bonus depreciation. What does that mean? So off the top of head, in the current law before the big beautiful bill, it was being stepped down 20%, 100, 80, 60, 40, 20 until down to zero. The big beautiful bill reinstated the 100% bonus depreciation for tangible personal property, machine equipment, stuff like that. Made that permanent into law, so that is now permanent with the big beautiful bill. Then a real hot topic and what we'll probably discuss a lot today, which is called new qualified production property. That is the potential opportunity for real estate, real property that goes into the production or manufacturing process that is a essential or qualified part of that production process to be 100% depreciated. So typically a commercial property, you build a non-residential property, it gets depreciated over 39 years, we'll say. We've all heard of cost segregation studies that allow for portions of that new build or renovation project to be accelerated, giving more depreciation expense up front than that 39-year. This new provision in the bill will allow even more, especially in the manufacturing industries, to accelerate depreciation even more. Some highlights to that, the construction of the QPP, or production property, needs to begin January 19th of 2025, but before January 1st of 2029, and placed in service before January 1st of 2031. And like I said, the key word here is integral. It needs to be an integral part of the production activity. We can dive into this later of what we know of what that means for now, but those are a couple big highlights. QBI deduction, that was set to expire at the end of 2025. That is that 20% business deduction on business income through pass-through entities, S-corps, partnerships, that gets passed through to the owners. That's now made permanent into tax law. And also there are new thresholds and expanding numbers to give business owners more opportunity to take advantage of that deduction. And there's a minimum deduction now in place of I think it's $400 minimum deduction for that. Another big one, R&D expensing. Before the big beautiful bill, research and development costs were required to be amortized over a 5-year period rather than expensed. There's still that R&D credit out there. That's still a major credit opportunity if you do have qualified R&D expenditures. But R&D expensing is now back on the table. You can expense it in the year that it is incurred and paid. Another provision to that or highlight is, so those amortized R&D expenses that you might have incurred over those few-year period that you had to amortize and expense it over that 5-year period. For companies, you have the small companies, and determined by the bill, 31 million average receipts or less. You can go back and amend those returns and get those accelerated deductions, or you have the opportunity to take it all of that unamortized expense in 2025 or spread it over 2 years in 2025 and 2026. So that's a major opportunity for the companies that have research and development costs and expenditures. Another couple, have been, hot topic for people are no tax on overtime. So the no tax, there's some caveats here. So there are limitations. It's capped at $12,500 per single filer. And a little, people don't, unless you get deep into the code. So, for example, if you make $20 an hour and you work 10 hours of overtime this week, so you're making those 10 hours, you're getting paid $30. So for that 10-hour period, the only portion that is non-taxable is the halftime, so that $10. So the original $20 that's your base pay, that's still taxable at the federal level. It's that additional $10 per hour for that overtime is the non-taxable portion, and it's capped at $12,500 per individual. Kind of same thing, no tax on tips. This was another, people were talking about no tax on tips. There is a threshold there, $25,000 cap. And I'm not 100% sure on this yet, but I was reading that potentially, so if you go to a restaurant and they have automatic gratuities, if automatic gratuities might be excluded from that no tax because the tip has to be discretionary. So that's another, I don't know how payroll companies or organizations are going to, decipher that and break it out. But anyway, that's another little nuance in the bill that on the no tax on tips. And then just two more things just to highlight, then we'll move on, and then we'll sure we'll have tons of questions. But the new Trump accounts, so the government's going to have these Trump accounts, and for newborns born 2025 through 2028, they will fund $1,000 into their Trump account. What I'm gathering from this is they're kind of like an additional savings and vehicle like traditional and Roth IRAs. But typically, if you have a traditional or Roth IRA, you have to have earned income to be able to contribute to those accounts. Well, I believe the Trump accounts, you don't have to have earned income. You can contribute to them for individuals 18 and under. And there are opportunities for employers to contribute to it and it to be excluded from taxable income and stuff like that. And then also the last one I just wanted to highlight real quick before we continue the panel is the estate and gift tax exclusion exemptions. So that was made permanent into law, $15 million per individual, and it's going to be indexed for inflation. So that's one also that I just wanted to highlight real quick.
That's a great summary, and we're so fortunate that we have experts who don't mind reading thousands of pages of legislative changes that could impact us. So that's a great summary. What type of projects or investments might benefit the most from the bonus depreciation changes?
So obviously, any new construction builds or renovations to manufacturing facilities or even warehousing and stuff like that definitely have the opportunity to take advantage of the new bonus depreciation reinstatement and qualified production property. I believe that, so there are exclusions to these qualified production properties. So the portion that we know now that will be eligible for the 100% bonus depreciation for the property is the portion that is the integral part of the production process. But that also includes, the storage, the warehousing potentially, because you can't have production or manufacturing without storage of the raw materials and the finished goods and those items. But it will also be important to still consult with your cost segregation firms and your trusted advisors to understand, if you're thinking about expanding or building new, have an idea of what portion or what amount will be eligible for that, because it's not going to be 100% of it. But it is still a great opportunity for companies that are thinking about it to really, move forward with consideration, talk with your trusted advisors, run cash flow scenarios. There's great opportunities for tax savings and cash flow savings. When I talk to my clients about this, we're looking at year 1, what's it look like, year 5, year 10 from a cash flow perspective. What you don't want to run into is a scenario where you're using a lot of upfront depreciation, as you would with this scenario, and then come year 5, year 10, you've utilized all your depreciation, and now you still have a sizable loan payment. Now you're running into tax situations, and with economic situations and uncertainties, business might be down. So just really consider, if you're looking at expanding, building, talk with your trusted advisors, your CPAs, your bankers, attorneys, insurance. It's really a full team project when it comes to these things.
That's a good point. So at what point would you recommend, if a business is looking at a upcoming project, of getting everybody in the room together, whether it's their CPA, the lender, their legal counsel? When in that process do you recommend bringing everybody around?
Very, very early. So, what we don't want to see or hear is, hey, I'm starting this construction project. We broke ground last week. Can you tell me, what's this going to look like for me? And what are my future cash flow and stuff, impacts? And what am I looking from a tax perspective? Really, step 1 is what I, recommend in getting your trusted advisors all on board and really looking over the project and scenario, what it looks like from, like I mentioned, the tax standpoint, cash flow, financing, insurance, the whole 9 yards. So I would say step one.
One of the things that we've run into, especially lately, is with the uncertainty of this, I feel like sometimes we've got customers that won't, when they feel like they're reaching out to a builder or a contractor, that they need to have basically a green light ready to go. And so we've been involved in conversations, even on projects that went to another builder ultimately. I mean, just in Wayne County, we've got countless reputable builders. And to have initial budgetary conversations and even looking into, okay, from a cost seg wise, budget wise, where would you place this? Where would you place that? It is some work up front, but in the grand scheme of things, to pick on attorneys, because I love doing that. I mean, you don't walk into the attorney's office and knowing what the final bill is going to be. You go in and start having a conversation and work out a game plan. So much like having those conversations with your CPA, with the bank, a builder can get involved pretty early, especially on the design build side of things, and give you those budgets and give you those breakdowns. I mean, I drive Josh and Taso nuts at times when we're pricing the same building 7, 8 different times because we're playing it out. And like Taso said, you know, pre-engineered has become really just a cost-effective way of giving a customized building structure. So the name doesn't do any justice there, but we're used to that. We're used to going back at it several times, adjusting for needs as things come up, budget variations, things like that. So just bringing that team together very early on, and oftentimes what they're asking for is, okay, how much are you looking to spend? Well, is your budget match up with any historical construction data? And a lot of different contractors can give you that information, or at least get you close.
And I would add to that, you know, you're losing out on a lot of value and opportunities for value engineering if you're not going through that iterative design process. Everyone wants a clear span building that I've ever met, but until they find out how much it costs, right? So it's really about figuring out what your process is, what you're enclosing, what the loads and codes are associated with the project, and then right-sizing the building to those needs. And then you can make intelligent decisions through the pre-construction process. So that's really where we can lend a lot of value working with Freeman on your construction projects. So make a decision. We're the designer and the fabricator, so we can give you real cost analysis of what those decisions are doing to your budget.
And to Josh's and the other panelists' point about getting together with your team of advisors earlier in the process, from a legal standpoint, it's almost always less expensive to plan ahead versus clean up on the back end. That's when you see significant cost, expenses, and delays, is when clients don't plan ahead and get their advisors together, and then the cleanup mode is very expensive at times.
You know, I'd like to add to that too, and of the panelists, I'm probably the generalist, inch deep, mile wide. This is applicable to every, you know, we're talking about specifics, you know, construction projects and CapEx and equipment purchases, but this is general to your business philosophy. Have a good team, have them assembled all the time, have financial preparedness, be capitalized properly, and set, you know, really good timelines, and that's in every business action that you take. So we have a diverse group here. I think everybody intuitively knows that, but as the generalist and the person that someone comes to fund a lot of this stuff, you'd be surprised how siloed most and often a lot of business owners are in their approach to how they deal with their team. So I think you can take this generally even beyond just what we're talking about today.
Those are all great points, and I would be remiss if I didn't say step 1.A should probably be reaching out to your local economic development organization, and if you're in the city of Worcester, Orville, or Rittman, the city's economic development teams as well. We work in partnership, but there are, depending on where you are in the county, local incentives. There are state incentives that can help support projects. And the earlier that we get involved, the better off your chances of obtaining some of those incentives are. Once the shovel's in the ground, it's a little too late, and you're missing an opportunity to bring in some dollars to help support those projects. So great. I'm going to move on to Roger and ask, what are some common misconceptions that business owners might have when it comes to leveraging tax incentives for capital investment?
Some of the misconceptions is it's just a lot easier to get the tax benefits than they think it really is. Like Josh indicated, these rules are hot off the press, one big beautiful bill or ABA or whatever they're referring to it as nowadays. And just to take a step back, Josh mentioned a couple key buzzwords when he was speaking. One was that some of these, including the 100% bonus depreciation, is, quote, permanent. So what does permanent actually mean in the tax law? Well, back in 2017, when they enacted the Tax Act, it was set to expire or sunset at the end of 2025, which was a big push for getting this extended. That was not permanent. This, although it's, quote, permanent, doesn't mean it won't change. So in 4 years, 8 years, 12 years, when there's a different group of individuals in charge and in control, that doesn't mean that bonus depreciation can't go away, that tax brackets can't be back up to 39.6%, that the standard deductions don't go back down, that the Trump accounts don't go away and become the Harris accounts or something along those lines. So you have to understand, although everyone is touting this as permanent, and we hope it will be for a long period of time and spur growth and economic development and things along those lines, I just want to make certain that everyone does understand what the true meaning of permanent does mean. The other part he mentioned was the integral part for the qualified production property. You probably have an idea what it is in the general sense, but it's still going to need some guidance from the IRS on what does an integral part actually mean. So those will probably be, or that will probably be one of the definitions they come out with through regulations and guidance to indicate what does that mean. The other terminology that they use is it has to be a substantial transformation of the tangible personal property through the production or refining process. Well, what does substantial transformation mean? So although this one big beautiful bill is exciting and sounds sexy, there's still a lot of unknowns, but it's still going to be extremely beneficial for folks who are looking at capital improvements in the immediate future. I don't know if I answered your question or got off on a tangent.
The other question we would have is sort of what are the legal pitfalls or potential audit concerns that companies might have when they're embarking on a new initiative?
I would say it's the unknowns at this point in time. So until there's clarification and guidance from the IRS, if you're teetering on the edge or walking up to the line, that's where the audit exposure comes. The IRS is supposed to come out with a form for making the election for the tangible, what's it called again, qualified production property. So they're supposed to come out with a form. They'll need to revise the new form that the form that they have right now for depreciation and amortization to deal with this sort of thing. So just making certain that all your ducks are in a row, that you have all the paperwork in place, everything that's required. Some of that is yet to be determined, but making certain that you have everything in place in case the IRS does come knocking at the door and initiate an audit, because those are never fun.
That's great. I guess I forgot to do our qualifying statement that you're not providing any legal guidance. I should have said that right from the beginning, right?
That's right. If you rely on anything we say up here, it's your own fault.
All right, I'm going to move on to Jeff with a couple questions about, are there specific loan products or something that you would recommend people start exploring when they're looking at capital investments or building expansions?
Sure, that's a great question. So, everybody's familiar with kind of conventional financing and just generalizing, 20% equity contribution, finance 80% of the project. Through some of the state and federal programs, there are programs such as the SBA 504 program. That's a partnership with a local CDC and a bank to put together a package to help someone reduce the amount of equity contribution they have to make to a project and can potentially give them a longer fixed rate on a portion of the project. They're deal specific, so sometimes it's a 10% equity contribution, sometimes it's 15 or even 20, but the piece that the SBA gets involved in is on a fixed rate for up to 20 years. So these programs that I'm talking about, they're very individualized, they're general, and you can go out on the SBA website, the state of Ohio, the U.S. Department of Agriculture, there are different programs like this, but it's specific to your project, so you have to know the details. And kind of back to how we started this, it's about setting up a team, having conversations, including your banker, having your banker give you options. In all of this, I think the second thing I said that was important is financial preparedness. I had an example yesterday. A guy came to the bank, wanted to buy a building. Very small company, had only tax returns for his financial reporting. His 2024s aren't done yet. So you're coming to the bank, asking for a loan, expecting the bank to look at year-and-a-half-old financial information. So, that's a very specific and a small example, but that stuff is super important, even to these loan programs. So SBA 504 program, just off the top of my head, the USDA has a kind of a similar program to the SBA's 504 program that's specific to rural communities, so applicable in Wayne County and the surrounding counties here. There's a lot of ability to utilize that. And then the state has an economic development program called the State 166 loan that's very much like that SBA loan that I described. So my takeaway for you here is, go to the bank after consultation with your team and then ask about maybe some potential options.
So Jeff, I'll ask you this, but also everybody else can weigh in as well. So how do you advise clients that might be a little bit hesitant because of economic uncertainty that a capital investment or a new initiative is probably best for them? How do you advise them on that?
Yeah, again, a good question. Again, this is individual. It's very specific to each circumstance. I talked about team, financial preparedness, capitalization, and timing. If you have good financial reporting and you understand your financial circumstances all the time, you're going to be better positioned to really know what you can afford. You'd be surprised people come to the bank and ask, what do you think? And, I always kind of lay it back on them a little bit. What do you think? And you'd be surprised that they're, blank-faced and don't know what to tell you. And, it's understandable. Everybody doesn't understand everything. Being prepared financially, being capitalized. People come to the bank a lot and want to finance something and think the only source of capital is for me to go get a loan. There's a lot of sources of capital, and the most important one is your own liquidity. So, in business, it's tough. It's tough to accumulate a war chest, but doing that is really paramount to being able to do projects and take advantage of these types of programs.
I do think, too, we're in an odd time, I think, between, well, I wouldn't say odd, just different than what we've experienced in the past. I know from just my seat, the customers that are moving forward right now are the ones that don't need to go to the bank necessarily. They've got other lines going, operating lines, but for expansions, they're either self-funded or they've got liquidity elsewhere. So looking at customers now who might not, what they want to do ultimately doesn't financially make sense today. Either the equipment they want to put in the space, by the time they pay for the space, they can't put the equipment into it. What we're also finding on the opposite side is we've got several relationships with development companies or individuals that are looking for opportunities where, hey, I'll step in and maybe put up a shell for you. And then you become the leaser and put your equipment into it. So you can still look at, okay, I'm making integral investments to my operations where you might have, a tenant build out type of tax advantageous situation. And then we can bring a team to the table that can help you close that gap a little bit. Again, the way I'm wired, I love looking at this stuff kind of a little bit differently and different ways we can build that puzzle that makes sense to move now. Take that advantage of maybe dicing it up a little bit, get another third party involved. Because ultimately, a lot of companies are just faced with the decision to either sit back and not do anything because where I think we need to go is going to be too capital intensive versus, okay, let's bring someone in to give us the shell, the facility, the space, and then we invest in our process. And ultimately, there's plenty of development opportunities out there where someone will step in, and if your goal is to buy the facility in 10 years, absolutely. They would be happy to jump on that because then that gives an end time to their risk. And so there's different ways to get to kind of stack it, and nobody walks in already knowing what that needs to look like. And you bring, one of the dumber guys in the room like me, I go in and I talk to these partners and say, what if we do it differently, or why? So then you're not out on an island by yourself.
So in keeping with the construction end of things for the Butler team, what are you seeing right now in the market regarding lead times, material availability? We know that's been kind of in flux the last few years. What's the current climate that you're seeing?
So we just finished our fiscal year here in June. We run July through June. We finished this fiscal year with about 75% more backlog than we did in 2024. So with that, lead times have extended. Our plants are pretty full from now until the end of the calendar year. So yeah, we over the last 4 months have seen somewhere in the neighborhood of $25 million a month in order entry. A typical month would be somewhere in the $12 to $15 million range. So you can get a sense as to the economic activity that's been happening over the last 4 months, at least on the Eastern Seaboard. I don't think we've seen quite as much activity in our central region and west, but I do know that their plants are largely sold out till the end of the calendar year as well. So there are, again, we talk about getting in early. The other part of getting in early is you've got the schedule on one side, then you have your budget on one side, you have your schedule on the other, right? So if you have an end date, a date that you have to be up and operational, it makes sense to get with a Freeman early and then start backing into your schedule because that's going to be critical to being able to execute the project in the timeline that you need to hit that delivery date.
Thank you. So what sort of is one thing that businesses often overlook when they're kicking off a project or coming to you and starting that initial planning?
Our approach to designing buildings is a little bit different. Pre-engineered, or what we call now precision engineered buildings, are, again, highly customized. So on a typical construction engagement, you would go to an engineering firm, they would design the building entirely, and then you would put that project out for bid. What we do is really design build, right? It's an extension of design build. You come to a Freeman to be able to design build the project holistically, because there's ways we can design the building that might add to your concrete cost, it might add to your erection cost. So really what you're looking for is to make sure that you're really keyed in on the in-place cost of construction, not the cost of the individual widgets that go into the job. And really that's the value that I think Freeman brings to the equation because, again, I can brace the building in a way that you're going to get a cheaper building, but at the end of the day, it's going to cost him more for concrete. And at the end of the day, it's going to cost you more for concrete. So it's really about balancing those different divisions of construction out to deliver the project holistically and for the best value for the end customer.
And to dovetail on that, we run into a lot of situations where, especially when you're setting these buildings up, you can hang anything off a building that you want, but nobody at Butler, nobody at Freeman will tell you that's the best way to do it. There's opportunities out there where we can look at your process, different either attachments or equipment you're going to have in the building, and there's different ways to stack the deck that ultimately can save you money in the long run because we get into things like large span airplane hangars. Totally different cost structure versus a warehousing model, things like that. But, Taso made the comment earlier about everybody wants a open, wide span structure, so you have no columns anywhere throughout your facility. Do you really need it? And then all of a sudden I want to hang something in the center of the building and your steel costs just go through the roof. They can certainly design it for you. They can certainly sell it to you. It's just a process by which you can go back and forth and really get down into what your needs are and how we can control that budget for you.
The last piece I would add is in terms of blind spots, I think I worked in corporate accounts for about 8 years before I took over the region, and I think there's an overconfidence in the contract drawings that an owner brings to the table when they're looking to design, for us to design and estimate a building. Generally speaking, architects aren't schooled on pre-engineered buildings. Same thing for engineers. They may spend a day in engineering school on pre-engineered buildings. And everything that we do is sort of a customized proprietary design. So, they'll bring us contract drawings, but the ambiguity of those drawings leaves a lot to interpretation. That can work for you in a very negative way if somebody wants to take advantage of that ambiguity. So at least with regards to the type of construction that we're engaged in, it's really important that you choose the right team because you can end up with, not with what you were looking for. And a lot of that exists, the problems that exist are derived from the ambiguity in the contract drawings that we end up using to estimate. They just introduce a lot of risk for the owner and for the general contractor if they don't know what they're doing. So generally they don't, sorry.
Okay, so AJ, what's your approach to helping clients plan their timeline through design through construction?
I think it's being realistic on the upfront end because everybody comes in and they see, especially by the time we're getting delivery of a building, really when you watch steel hit the site and go up, it's such a small fraction of the overall duration of the project because the outside, the skin of that building goes up in a matter of months or weeks, depending on the size of the building. But really between the planning, the permitting, and everything else involved, any type of build out that goes in the structure afterwards. As I was looking at the dates on this bill, as far as the put in service dates, and yes, you've got a 4 to 5 year put in service duration, but you start looking at, okay, we've got the next 3 to 4 months into just deciding what we want and getting to an overall team together, a price. And then you go into permitting. That's, let's face it, it's not getting any easier. It's just a combination of just different requirements that things are going on. So now you got 5 to 6 months there. You're a year into this process and nothing has happened on your construction site. And then I'm having conversations in the background with suppliers like this that are experiencing whether we have this bill all straightened out right now or what the ramifications are not, which clearly there's a lot of implementation hurdles that are going to be going on here, but they're looking at, because of the perceived advantages, which they're real, we just haven't totally fleshed them out, they're looking at back orders that are as long at, nothing will compare to COVID, let's face it, but are as long as we've seen in any normal operating period because of the volume. So you start looking at, okay, how do I slot in these long lead time items? And very easily, you're getting to 24 months by the time you're looking at any put-in service date. So really, your window just shrunk in half, which doesn't mean there's still not a lot of time for planning and figuring out exactly what you have. But having that conversation up front that, hey, let's talk and figure things out. And then if you have to go take 6 to 8 months to make sure your system, this makes sense for you financially and for your business, that's fine. But let's have those conversations on the front end. I tell people I really want to get in and have that conversation when we're at the idea phase, because we can offer a little bit of value then as far as setting you up for success or control cost for you. And it doesn't matter if you have to go operate your business, do what you do well for another year and come back to it. But then you're at least armed with the information of, in a general timeline, here's where we're going to get you, because the most terrible thing that I already have fears of is we get into 2029 and I get a customer I've been going back and forth with that I haven't communicated well, and they're saying, hey, we got to go. I got to get this thing in service to take advantage of everything I've been planning on. And because of timing, your whole model just fell apart. So
We're seeing a lot of that. Yeah, I was going to say, we're seeing a lot of that now. We had a slow spring last year leading up to the election, which is pretty typical. We see it every 4 years. But quote activity didn't slow down. So quote activity was at a really high pace. We just weren't seeing the order entry through the spring that we typically would have seen. And all of that kind of came to fruition once we got into April of this year. So what we're seeing right now in terms of activity is really the backlog, I think, of opportunities that we were quoting back in April of last year. So what we have is owners coming to us and then they're surprised by their delivery dates because, they've been working on their project, waited to the last minute to come to us, and now it's a surprise.
Well, what should a business consider if they're planning or forecasting for investment in the next 12 to 24 months? What type of things should they be taking into consideration now?
I mean, at this point, it's, people are still reacting to, I think industry in general coming out of an election year, I only know a few industries that really didn't experience that dip because everybody was just wait and see what happens. And so now, we're establishing a baseline so you can start putting together those predictive models that, the bean counters down at the end, they like to extrapolate out. And so you're trying to, sorry about that, Josh. But, and so we're just getting those models together. And so another input of expenditures on top of it. And it really turns into picking a team, picking a partner that's really going to start putting all of those variables on the table for you. Because everyone we work with, what we do is not their business. Their business is the reason why we've been brought to the table. They're experiencing growth, experiencing success. It's a good thing. But putting all those puzzle pieces together between timing and, hey, I've got my accounting team over here that they're trying to protect me in what's going on. I've got my bank over here that they're trying to be ready when it's time for us to go. But they need their inputs as far as overall financial requirements, things like that. So where we're just a builder, at the same time, we've had the reps. It's the repetitions of, have you thought about this? And then you bring in economic development, and like you brought up earlier, it's your conversations need to happen very early on. There's been plenty of deals that we've had a building ready to go, and then all of a sudden we have to slam on the brakes because there's some incentives that need to go through. Or all of a sudden, hey, I hired my buddy that's an excavator down the street to just get things ready and moving, and pretty soon you just lost out on one of your inputs that you had on your financial model. So it's not, guys in my position, we certainly don't know everything we're talking about as far as the details, but we've had the reps of watching both the success stories and the failure stories of watching some of the team fall behind or not have the information. So it's a very broad answer to your question, but that's all part of the just general let's have a conversation side of things.
So bankers are pessimistic. When we look at opportunities for people or someone who has a request of us, we generally are going to sensitize everything. Sensitize revenue. Is there a chance somebody could lose a client? If they do, what's the impact? We sensitize margin. If cost structures go up, what's that do to their cash flows? We sensitize interest rate. If interest rates all of a sudden start to spike, what does that do to their projects? So I think for clients, working closely with their accountant and their advisors to kind of prepare for that all the time, have a sensitized business model that you can kind of manage and move on a regular basis is really important.
That's great. I'll give you, Josh, an opportunity to get back at AJ before we get a question from the audience, if you wanted to dig back at him. No?
I'm good. I did want to just mention from a financing standpoint and correlating to the accounting piece, it's really important if you are looking at a capital project or financing to understand what your debt covenants are. We have clients all the time that are doing an expansion and getting a new loan, and they don't really understand the requirements that the bank is going to require moving forward. For example, maybe they haven't had to have some sort of assurance like a review or an audit done of their financials. Well, now, the bank is requiring it, and now all of a sudden they have more accounting and CPA fees. There's certain timing requirements like, mid-year ratio analysis, making sure that they're hitting certain levels to be in compliance with their debt. We see that a lot, and it's really important to have that understanding of when you do go and get financing for a capital project that you do understand what your requirements are and making sure you meet those.
And that circles all the way back to the beginning, talking about your team. If you're going into projects and you're going into financing structures, your accountant, your attorney should be involved in that so that they're helping to represent you with the bank. Again, banks are going to be most conservative. And as we've talked about implications of this new legislation, the certain tax implications can have impact on financial covenants. So again, having a good, closely organized and closely connected team is really important.
Great. Well, thank you. As a reminder, if you don't want to ask a question live, you can post that with the QR code. But I think, Gene, we have a question from the audience.
Hello, and thank you all for your time and input here. So I just had a question about the financial modeling piece, and specifically, I saw an expansion planning worksheet referenced up there. If you're an owner or a person in charge of a project and you're just setting out on this, you guys know, if you've gone through it before, there are literally thousands of variables in your cost, in your revenue, tax, architectural design fees. We're talking about tariffs and the cost of construction inputs. So I've heard numerous times and wrote it down and put a star next to it, like get a team together and go through it. But if you're just setting off, is there a process that you recommend, whether it's, sit down with your economic development team or somebody with the state of Ohio because they have services that can help you through these processes, or maybe a website that you can access, something commercial that you have to pay a subscription for, but that can just help with that financial modeling piece, asking for a friend here. But, I've gone through that recently where it's like, you sit down and what do you want to do? Well, we want to do what we can afford. How much can you afford? I have no idea how much anything costs. Okay, so where do we start? And so for somebody going through this for the first time, I just wondered if you had any advice or recommendations. Financial modeling specifically.
We see just a multitude of that. And like I was telling you the story about somebody that had tax returns. There are some resources, and maybe Mary Beth has some input on this too, that you can go to for assistance with things like this. In Canton, there's SCORE. Kent State has a small business development center that you can leverage. Frankly, you'd be surprised what you can find out using, AI. For me, I always encourage people to make sure they find a good tax and accounting consultant. A lot of times those folks, while there's an expense to doing it, which if you're going into business, you've got to, come to the realization that there are things that I'm going to have to pay for that maybe aren't ultimately, they don't feel good, but they're really important. And, paying for good advice is really important. So, leverage some of the stuff that's free. And then also, talk to a couple specialists to see if they can give you some advice on that.
I mean, certainly if you're looking at expansion or things like that, even equipment investment, establishing, okay, here's the desire of what we want, and having those preliminary conversations, even from a similar type project, square foot basis. The budget you're talking about is 10,000 square feet, not necessarily 20,000 square feet. Those are the conversations we have a lot of just on the front end, just because that's such a large expenditure in it. But then after that, then I would pass it off to these guys as far as modeling that out with what it's going to look like. Because I know we've worked with customers that bring us in to where they're looking at the last 4 to 5 years, trying to project it out, say we're growing because of X, Y, and Z, and coming up with those type of numbers. But, like Jeff said, is the bank's going to be the most conservative for sure. So getting that initial stuff together, and then if there's additional resources for the small business side of things.
If you're an established business and you've been with a financial institution for a while and you provide financial statements to them annually, we're trend analyzers. So we take your financial statements, we put them in a system, we call them spreads, and then we can see, balance sheet, income statement movement, statements of cash flow, financial ratios, ask your bank if they'll share that with you, because that's a pretty good fundamental review of what's happened in the past. Then you might be able to leverage how they've done that for you to layer on future forecasting model. So that might be a very simple way, if you're an existing business, to get some help from your bank about kind of what you look like to them.
Great. Well, this is a great opportunity for you to be able to ask our talented panel without paying an hourly rate what your questions might be. So are there any other questions from the audience for the panel?
Hi, thank you all for coming. I just have a question. If you are renovating an existing building versus building new, are there any either cost increases or increased lead times that you might anticipate because of tariffs or because of items in the big beautiful bill?
The lead times in general, based off my crystal ball, especially on the renovation side of things, we haven't seen a huge swing or forecasting a huge swing. There's been even price increases. We've seen things like HVAC equipment, some more technical stuff that has gone through some increases. Insulation's one of those things that always seems to be climbing, but especially looking at more of, talking the steel market, my pessimism, I was waiting for tariffs and even the domestic side start creeping up a little bit. We had our normal increases that are early part of the year or in late year, early the next year. But I really haven't seen a whole lot of movement there, and you guys can speak to that more than I can. But in general, especially on the renovation side, there's nothing at this time that's, we're all coming off that scar tissue of 2020 and beyond that, nothing in comparison to that.
Yeah, we saw a bump after the initial tariffs were put in place. We saw another bump in the steel market after the reciprocal tariffs were announced, but they've all sort of right-sized back to a market that is not overwhelming the system right now. We don't expect to see any dramatic increases in terms of steel pricing here, at least based on what I've seen recently for the next 6 months or so. The demand's just not there. I think a lot of that's driven by the automotive market, but I can say that our pricing's been pretty static here for going on 4 or 5 months. In terms of renovation, you can potentially renovate faster than you can build new right now, but that's primarily due to the fact that we can push that material, at least speaking on Butler's behalf, through our plants a little faster than we can a fully engineered system.
One of the things that we've had a lot of interest in lately is the roof over side of things. So you've got these big metal buildings that have been around for 40, 50 years at this part, especially a place like Worcester that has, had a life cycle or two underneath them, performed well, nothing wrong with the building, but here comes water. And so those components are more of the mass-produced side of the pre-engineered when you're looking at putting a metal roof over top of the existing one. So as far as getting your hands on it, very quick. As far as costing, doesn't fluctuate a ton because those are components from a secondary side of things when they're producing mainframe steel, heavy steel. This is kind of just a necessary byproduct that goes along with it. I'm oversimplifying the terms that you guys use, but in the grand scheme of things, that side of things that I can see, depending on how all this shakes out, is let's put an investment in our building, put a roof on it that's going to last another 40, 50 years. As far as a decision maker now, I won't have to deal with it again. Those type of interest and those type of renovations and investment in the buildings, I don't see any significant. Our experience in the last couple months, and then looking forward, I don't see any big changes there.
Yeah, and I do know if you go like over like, I think you can depreciate 100% of it in year one as well. So there are some tax advantages to that approach if you're doing metal over metal, that type of roof system.
I do want to just talk real quick on some timing on the big beautiful bill. So as it relates to from a tax standpoint, so the bill got passed on signed by President Trump on July 4th. So now, the IRS and different agencies are reviewing and reading and trying to interpret the bill. So the IRS, Medicare, Medicaid, defense, et cetera, are reading the bill and trying to interpret it. So then they're going to have to release guidance on how they read it and how it's going to actually come into practice. So then once we get that, they'll begin updating forms, instruction sheets, and et cetera, as it goes in the tax code. So from a timing standpoint, I can tell you with confidence that if you are a typical tax filer that doesn't file extensions, get them done on time and filed well, there are probably going to be a lot of new or existing forms that will need revised and updated, but they won't be ready. And so extensions will probably have to be had. But like we've been talking about, communication with your CPA and your other trusted advisors will be critical. And not to paint a horror story but if some of you recall back when the Tax Cuts and Jobs Act of 2017, the whole qualified improvement property came into play. Well, it actually got written incorrectly into the tax code. So a lot of items that we thought we were going to be able to fully depreciate were not because of how it was written in the code, and it finally got corrected, but not until the 2020 CARES Act. Well, hopefully that doesn't happen this time, but it has, happened in the past. So,
Justin?
There we go. All right, perfect. Two-part question. AJ, on the building end, have you seen any softening of the energy requirements? I know that's driven a lot of the building costs sky high. And so, or do you anticipate any softening there with the new administration? And then secondly, to our banker friend, how you looking at rates? Both today, I'd hit you on it, Jeff. And then how does the future look for rates on commercial industrial end?
Do you want me to hit that first?
Go ahead.
So I think people saw the Fed kept rates flat. So Fed fund rates 4.5%. Everybody's hoping for reductions, and obviously nobody more than the president. And he's putting a lot of pressure on Fed chair. But I personally, from what we're hearing and talking about, potential softening, but pretty level interest rate environment. We're sensitizing with a pretty flat rate right now, so we'll see.
The energy code side is probably, even for once, I'm more pessimistic than Jeff. What a lot of people don't always realize is the energy code gets the two bodies that come together to write the code. They actually rewrite it every 2 years, but states and municipalities don't adopt it, but for every 6 to 8 years. So there's a lot of revisions that happen that just don't become code. So there's also, when a new code is adopted, it's pretty much, it's been toyed around with a little bit, at least from a legislative side. So as far as ratcheting it back, I doubt it. My hope is, okay, we've got where we are right now, and then they kick that out even further because we go much further than where we are. They're really lumping us in with a lot of, we're becoming more like the Northeastern as far as requirements, U values. And the biggest switch, you go into Lowe's and everything's an R value. When it comes to energy code, that doesn't mean anything. They look at total assemblies. So Butler's actually put, and other companies as well, but Butler has put a lot of R&D dollars into looking at a total assembly from, okay, what type of insulation you want to put in there along with their structure. Everything from the spacing they put into sidewall or roof clips, because that all compresses insulation, which might be the same R value, but the U value, the total assembly, doesn't change, or does change. So short answer is no, I don't see that lessening. The second part of it is new mousetraps are being created to try and get us someplace that's not as painful as the early implementation, but we're never going to go back to 2 years ago.
Hey, to Justin's question, to just for some context right now, Fed funds rates 4.5%. Prime usually 3%. When you hear people talking about prime. Prime's usually 3% above the Fed funds rate. So you're talking 7.5%-ish variable rate. I had a rate quote this morning for a client for an interest rate swap. That's a specific kind of way to fix an interest rate. Pretty good client, pretty good interest rate spread. So we'll use a short-term interest rate indice and then add an interest rate spread to come up with what we're going to charge somebody. And that interest rate spread's usually relative to the credit risk associated with that transaction. Sometimes competition drives that, but it varies. So this is a project, so they have a 9-month forward on their rate, and the 3-year fixed rate was like 6.38. 5-year 9-month forward, 5-year fixed rate was about 6.5%. So where I'm going with this is, you're in the 6.5% to 7.5% rates right now, usually, if you're moderate credit risk or better. If you're doing a project, sensitize it. I'll get proposals from people for a project, and they've got the lowest possible interest rate assumption that they could have, and they just meet their cash flow coverage. So be thoughtful. If you're going to go to the bank, talk to the bank, be realistic, show the bank that you've thought about a worst case scenario, not always the best case scenario, and you're going to gain a little bit of credibility with that banker. So hopefully that's helpful.
Josh got a lot of grief from builders when Energy Code came out, so I saw you twitch a little bit. I'd like to get your thoughts as far as your response.
Well, as far as the energy codes that we have today, March of 24 was when Ohio adopted the latest energy code. I believe it was 9 years before. It's been 9 years since we've changed our energy code. So what we were doing prior to March of 24 was significantly simpler, more cost effective than what we have to do today because of what we've got to achieve in the new energy code. The fact that it was just recently in the last year adopted, it's not going to change anytime soon, hopefully, because every time it changes, it gets more stringent than the last time. I do think, from a construction pre-con discussion with whomever team you're working with, it is a huge factor, and how you accomplish what you need has huge variances in dollars and what it means to your project, not just in the construction costs, but your long-term operating costs of that facility as well. As AJ said, Butler as an organization has spent a lot of time testing our installed assemblies, and that's what the new energy code is all about, is the installed assembly. Just like with the new legislation, it takes time for everybody to figure out how to make it work. What does it actually say? So right now, what we're seeing is kind of a Wild West situation, and when it comes to energy, is because many of the manufacturers don't incorporate an insulation system into their product, so that it becomes a piecemeal project of, well, the building does this and the insulation does that, and we try to, at Butler, we have kind of an all-encompassing approach that we know our building with this insulation achieves these values. And in a lot of cases, we're seeing projects going out the door that's like, there's no way that meets the energy code, but the code officials don't fully understand it. They're signing off on things. Architects don't fully understand it or what's available to them. So it is something that to be addressed with your pre-con team about, okay, how are we going to address this? What are our needs? What makes sense? And, because there's a lot of different ways to go at it.
Again, that's that ambiguity in the contract drawings and specification, and it's all subject to interpretation, and then you take and fragment it where, typically we're selling our insulation with our building, so one throat to choke. As soon as that gets sent out to someone else, all of a sudden they're responsible for interpreting what the code is and what's needed for that building. And yes, maybe you win, maybe a contractor wins that and you award that contractor the project at that cheaper price, and maybe it goes through, or maybe you get caught, right? So it's a blind spot. You just want to make sure that you're covered.
think we had time for one more question, and since Ben is on my board of directors, we'll let you ask it, Ben.
This is a simple one. For the bonus, the 100% bonus depreciation changes, is it new construction only, or is there a retro portion to that as well?
For the qualified production property, it doesn't have to be a new build. It could be a renovation or an expansion or a remodel of an existing building.
I mean, I didn't ask it properly. There's no, like, the R&D expense, you can go back and modify what you did before. We built a building a couple years ago. Is there any chance to change the depreciation schedule of that?
No, it has to be placed in service after January 19th of 25 for it to count. No retroactive like R&D.
Okay, well, we want to take a minute to thank our panel today for being here and providing such great guidance and advice for us. So thank you. So obviously, we are fortunate to have so many experts in our own backyard, and I encourage you to follow up with them. They'll be hanging out a little bit longer this afternoon. If you have other questions that you want to ask them, feel free to reach out. Obviously, the key message that we heard multiple times today is start early, start thinking about this, bring your team together as soon as you can. Get your plan in place and make sure that you're building smart and not forgetting to contact your local economic development folks to see how much assistance can be provided on your projects. So with that, AJ, I'm going to turn it over to you for any last words.
Yeah, so you're welcome to stick around. By all means, we know we have things to get back to, and depending on interest as we're around, if we've got some examples of Butler buildings in the area that we can, do a drive-by, that sort of thing, if anyone's interested and not in a rush to get back to work.